For decades, long-term planning was one of the defining strengths of American businesses. Companies invested years ahead, mapped multi-decade strategies, and made capital decisions based on relatively predictable regulatory environments. That mindset is now shifting. Across industries, regulatory uncertainty is quietly but profoundly changing how U.S. businesses think about investment timelines, expansion plans, and risk. Instead of asking how big or how fast they can grow, many companies are now asking how flexible they need to be. This change isn't driven by a single law or agency. It's the cumulative effect of unclear rules, delayed guidance, and constantly evolving policy signals that make long-term commitments harder to justify. Regulatory uncertainty today looks different than it did in the past. It's not always about strict regulation or deregulation, it's about ambiguity. Businesses are often unsure which rules will apply, when they will apply, and how aggressively they will be enforced. That lack of clarity introduces hesitation at every stage of the investment process. One of the most visible effects is the stretching of investment timelines. Projects that once moved from proposal to execution within months are now taking years. Companies are delaying final approvals, breaking investments into smaller phases, or waiting for clearer signals before committing significant capital. This doesn't mean businesses have stopped investing altogether. It means they are moving more cautiously and deliberately. Capital-intensive industries are feeling this shift most acutely. Manufacturing, energy, infrastructure, healthcare, and financial services rely on long-term investments with long payback periods. When regulatory conditions are uncertain, the risk profile of these investments changes. A factory, power plant, or data center built today must operate under rules that may look very different 5 or 10 years from now. As a result, many companies are redesigning projects to reduce long-term exposure. Instead of building large, centralized facilities, firms are opting for smaller, modular investments that can be expanded or adjusted later. This approach offers flexibility, but often comes at the cost of efficiency and scale. Businesses are trading maximum upside for reduced downside risk. Another major change is how companies sequence their investments. Rather than committing all capital upfront, businesses are increasingly staging investments across multiple decision points. Each phase depends on regulatory developments, market conditions, or policy clarity. This phased approach allows companies to pause or redirect resources if the regulatory environment shifts unexpectedly. Regulatory uncertainty is also reshaping how companies allocate capital geographically. Some U.S. businesses are delaying domestic investments while exploring opportunities in regions with more stable or predictable regulatory frameworks. Others are keeping capital closer to home but postponing expansion until clearer guidance emerges. The result is slower deployment of capital, even when demand exists. The impact extends beyond physical assets. Hiring plans, technology adoption, and product launches are also being affected. Companies are cautious about expanding headcount if labor rules, classification standards, or compliance requirements are unclear. Similarly, businesses may delay launching new products if future regulations could require costly redesigns or restrict market access. This uncertainty is pushing companies to shorten their planning horizons. Long-term forecasts are being replaced with rolling, shorter-term plans that can adapt quickly. Instead of 5 or 10-year investment roadmaps, many firms are focusing on 12 to 24-month windows. This makes organizations more agile, but also limits their ability to pursue transformational growth. Boards and executive teams are playing a more active role in navigating this environment. Regulatory risk is now a central topic in investment discussions, alongside financial and operational considerations. Decision-makers are asking not only whether a project makes sense financially, but whether it can survive multiple regulatory scenarios. Legal and compliance teams are also gaining greater influence. Their assessments increasingly shape investment timing and structure. Companies are spending more time modeling best-case and worst-case regulatory outcomes, which adds complexity and slows decision-making. While this reduces the risk of costly mistakes, it also increases the cost of inaction. Smaller and mid-sized businesses face unique challenges in this environment. Unlike large corporations, they often lack the resources to absorb regulatory surprises or navigate complex compliance landscapes. As a result, smaller firms may delay growth investments longer or avoid certain markets altogether. This can reduce competition and innovation over time. Interestingly, regulatory uncertainty doesn't always stop investment. In some cases, it redirects it. Companies may invest more heavily in automation, digital systems, or compliance technology to reduce exposure to regulatory changes. Others focus on business models that require less fixed capital, allowing them to adapt more easily as rules evolve. This shift toward flexibility is changing how success is measured. Instead of prioritizing rapid expansion, businesses are valuing resilience and optionality. Being able to pivot, delay, or scale selectively is becoming a competitive advantage. Companies that can operate effectively under multiple regulatory scenarios are better positioned to navigate uncertainty. However, there are broader economic implications. When many businesses delay or downsize investments simultaneously, overall growth can slow. Innovation cycles may lengthen, infrastructure development may lag, and productivity gains can be postponed. These effects are subtle but accumulate over time, influencing the pace of economic expansion. Regulatory uncertainty also affects investor expectations. Investors are increasingly attentive to how companies manage regulatory risk. Firms that demonstrate disciplined capital allocation and flexible planning may be rewarded, while those that commit heavily without accounting for uncertainty may face skepticism. This reinforces cautious behavior across the market. Looking ahead, regulatory uncertainty is likely to remain a defining feature of the US business environment. Even when policies eventually become clearer, the experience of recent years has reshaped corporate behavior. Businesses have learned that assumptions about stability can change quickly, and investment strategies must reflect that reality. In response, US companies are redefining what long-term thinking looks like. It's no longer about locking in a single path and executing it over decades. It's about building strategies that can evolve, investments that can pause or pivot, and organizations that can respond without overcommitting. Ultimately, regulatory uncertainty isn't just changing when companies invest. It's changing how they think about growth, risk, and the future itself. And in that shift, flexibility has become just as valuable as ambition.